Hey, good afternoon, everybody. Welcome back. I hope you've enjoyed some time to engage with some of your old friends and hopefully made some new ones. We're excited for how today has gone already, so thank you all for coming out and joining what will continue to be a really exciting way for our alumni to engage back with not only with our school, but also with our current students. I'm Arthur Mills IV, and I'm the current chair of the MBA Alumni Advisory Board, and we're thrilled on how well this day is going. So could we please give a quick round of applause to our MBA program staff? Now, my wife might say that I never met a mic I didn't like, so let me move into what I'm actually supposed to be doing, and that's introducing a dear friend of mine and classmate, by the way, Mr. Lance Loeffler. I'll read his bio just because, and then we'll get him up here so he can give his remarks. Currently, Lance serves as Executive Vice President and Chief Financial Officer for Halliburton. In this role, he leads the company's financial strategy as well as its financial institutions, including financial planning and analysis, accounting and financial reporting, tax, internal assurance, treasury, corporate development, and investor relations, if that wasn't enough. So pretty long sentence, but that's just really indicative of how incredible Lance is. He joined Halliburton in 2014 as Vice President of Corporate Development with global leadership responsibilities for the company's strategic merger and acquisition services. He then served as Vice President of Investor Relations and was responsible for the development and implementation of Halliburton communication strategies for the investment community. Prior to joining Halliburton, Mr. Loeffler held director positions at Deutsche Bank Securities, Inc. and UBS Investment Bank, where he focused on the firm's oil and gas clients. He holds an MBA with concentrations in finance and accounting and is in this year's a reunion year of 2004. He also holds a bachelor's degree in finance from the McCombs School of Business, also in that reunion class of 1999. So he's a double horn and a proud friend of mine and member of my class as well. So without any further ado, Mr. Lance Loeffler.
Thank you, sir. Thanks. Good afternoon. Thank you, Arthur. Thank you, Christine, and thank you to Dean Hartzell for the opportunity to be here today. It's a real honor. As some of you know, I was born and raised in Central Texas, only about a couple hours drive from here. And after receiving my undergrad from McCombs, as Arthur went through in my bio, and a short stint in corporate America during a burgeoning biotech bubble, I sought really a catalyst to reposition myself within my finance career, knowing that I wanted to make a long-term career of it. And so that's what led me back to the MBA program here at McCombs, where I had the pleasure of meeting Dean Hartzell in his second core finance class, which I'll come back to in a minute. But that decision helped me lay a solid foundation for my career and my future growth. But it also introduced me to that core finance professor who pegged me with one of the most French-sounding nicknames that a person could come up with a German heritage. And I will tell you, that day started off where Jay actually called roll in our core finance class, and he got to my name and tried to pronounce it, and it came out Loeffler. And from then on, for the next 2 years, that was what I was known as in my MBA class. Anyways, I know he's not here today, but I will continue to give him a hard time about that. Anyways, after graduation, I pivoted into the financial services sector and into investment banking in New York. But I always knew I wanted to be back home in Texas to raise my family. And just like in antiquity, all roads led to Rome, in present-day investment banking in Texas, all roads led to Houston and oil and gas. And after 10 years in investment banking, almost, the corporate world came calling. My expectation was that I was leaving the fast-paced hustle and bustle of deal-making for a more sleepy corporate setting. Little did I know it was anything but that. I've led M&A activity that's ended up on the front page of the Wall Street Journal. I've testified in front of the Department of Justice, and I've been responsible for setting the strategy for a $30 billion company. And now, here I am in front of you, applying my education and expertise as the CFO of the largest U.S. oilfield service company in the United States, Halliburton. Many people ask about that transition from financial services to the corporate world and what got me to where I am at the age of 42. So I'd like to just share a few things about that before we get into the rest of my remarks. The first is hard work, right? That's a given. Everyone talks about it. But it means different things, I think, at different stages in your life. I was prepared to spend 18-hour days sitting behind a desk job in New York to put in the hours and the sacrifice to set that solid foundation for the rest of my career. The second thing is don't delude yourself. It's great to have aspirations, but to be honest with what you know, but also what you don't know, and then work hard to close those gaps. I set a personal goal coming out of investment banking that I one day wanted to be a public company CFO. But I knew quite well that I still had a lot to learn about the role, the business, and the industry. Third, I think it's important to have quiet confidence in the abilities that you do have. I think it's a balance. Everyone has to come up with that right balance on their own between that and the prior point about being delusional. But I think it's important to show that confidence, particularly as you're leading your teams and your organizations. And finally, play nice in the sandbox. I think you have to be a good teammate, but you also have to understand your role. Sometimes you're the starting quarterback, sometimes you're the coach, sometimes you're the backup linebacker. But I think the most important part is that you're able to deliver what the team expects of you, and then good things will happen. So enough about me and my background and the stories. What I'd like to talk about for a moment is the future, and more specifically, the future of energy. In today's world, there's a lot of skepticism and uncertainty out there about the energy industry. There's talk about the energy transition away from hydrocarbons, peak oil demand, and pervasive apathy from Wall Street towards energy. Despite the rhetoric, I'm a bull like John was earlier. I still see a world where oil and gas consumption is incredibly relevant to human life, and our industry, the oil and gas industry, continues to make life better for people everywhere. Long-term demand fundamentals for energy are strong. So what will drive this demand going forward? The answer is people. People striving to improve standards of living for themselves and for their families. It starts with the basics, access to food, water, and shelter. And then it moves to lighting and heat for homes and schools, and ultimately advances to improved medical treatments, transportation, and modern conveniences like refrigeration and air conditioning. These modern improvements in turn lead to higher levels of education and income, as well as living conditions, longer lives, and a number of other advantages that frankly sometimes we all take for granted. By UN estimates, 1.3 billion people across our world today lack electricity. That's 7 out of every 10 people in Africa and 2 out of every 10 people in Asia. It's a problem of vital importance that these societies and the enormous implications ultimately around future energy demand. Access to reliable and affordable energy is essential to modern life, and as billions of people strive for better living conditions, the world's need for energy will continue to grow. But what form of energy will it take? No one knows that quite for sure yet. However, in order for low emissions renewable sources to replace oil and gas, they have to do 3 things. They must be reliable, scalable, and affordable. Today, hydrocarbons are energy dense. And when I say that, I mean they work at scale, they are globally available, and are easily transported, which makes them the fuel of choice. Our industry continues to deliver that affordable, abundant barrel of oil and gas, and until there's that viable substitute with similar attributes, our industry is by far the best solution for powering the progress of the human race. So let me talk a moment about near-term supply-demand situation in the energy markets. We currently find ourselves in a precarious balance with lots of transitory issues weighing on both supply and demand. U.S.-China trade tensions and economic data coming out of China and Europe cause near-term fears around a looming global recession, and then therefore uncertainty around energy demand. But, as this week would tell us, the recent attacks on the crude complex in Saudi, combined with Iranian sanctions, Venezuelan production declines, and the political instability in countries like Libya and Sudan are creating meaningful supply disruptions. On top of all of this, we have the OPEC Plus countries that have extended their supply agreement until March of 2020 and continues to limit production to support oil prices. So let's take a look, though, for a second at what we see over the next decade. Demand growth for both oil and gas will continue, driven by those sizable economies that I mentioned earlier, in particular India and China, and the industrial and petrochemical build, particularly in the Middle East. With the focus on cleaner forms of energy, natural gas demand growth will outpace oil demand, driven by the electricity consumption and industrial demand on a global basis. To illustrate this point, China is shifting its coal to gas for its electric production. Over the next 30 years, the gas demand just from China alone is projected to outweigh demand growth from the next 10 largest growth countries, which is pretty amazing. Meanwhile, in North America, shale plays that have been responsible for the U.S. becoming the world's largest producer will continue to industrialize and to mature. It's amazing that only 9 years ago, U.S. production constituted only 1% of global oil supply. And today we produce more than 10%. That breakneck rate of production growth is above and beyond any other period of production growth in any other country ever. Even the discovery and rapid ramp up of the Western Siberia oil fields in the Soviet Union in the 1960s pales in comparison. So all of this is interesting, right? I think it even gets more interesting for the CFO of an oil and gas company. The recent prolonged down cycle is forcing change across our industry, no doubt. The operators, the service providers, and the equipment manufacturers can all attest to it. But as a result, we've witnessed a seismic shift with really heavy implications in the oil and gas investor base. The signs of this shift are pretty easy to spot. I think John was alluding to it earlier in terms of his portfolio allocation and the opportunities he sees in terms of value today. But WTI, for instance, has gained over 25% since the beginning of the year. However, top energy indexes like the OSX are trading at levels last seen in the early 2000s. Stock valuations have simply decoupled from oil prices as investors have grown frustrated with the energy sector and have simply allocated their money elsewhere. The oil and gas private equity model isn't better off. Investment returns have become elusive, and the traditional exit options are cloudy at best. Oil and gas stocks currently represent only about 4.3% of the S&P 500, which is an all-time historic low. Investors are clearly sending our industry a message that something needs to change before capital returns to this space again. Just a few years ago, all investors wanted to focus on was growth. Production growth for our operators, market share and revenue growth for the service companies. As U.S. shale matures and the talk of peak oil demand looms large, growth-focused investors have literally left the building, moving their money to the high-growth sectors of tech and healthcare. So today we see those value investors that are seeking the yield. Value investors focus on a company's ability to generate strong returns and healthy free cash flow. They seek different behaviors from our industry and reward different actions. So where do we go from here, knowing that? I think it starts, if I had to say, it starts with two words: capital discipline. The zeal for growth at any cost is over, like I just mentioned, and it's unlikely to come back anytime soon. And so too is a world where our returns are significantly higher than our cost of capital, which made capital allocation decisions a breeze. For Halliburton today, our returns are on razor's edge compared to our cost of capital. So therefore, we must be hyper-focused on capital discipline. And ultimately, capital discipline drives better returns because the capital scarcity that it provides ultimately leads to better pricing discussions. And frankly, the less we have to spend on capital today, the more profit and cash we can allocate elsewhere. Industry balance sheets need to be cleaned up, and shareholders are hungry to see a return of cash through either dividends or share buybacks. All of this makes for a really interesting operating environment today, especially here in U.S. land. As I said earlier, WTI price is buoyant, yet operators are on track to spend 11% less on drilling and completions this year. Takeaway capacity constraints that plagued the industry in the second half of last year have been resolved in various basins, and yet the U.S. land rig count is down 17% since the start of the year. As you see, capital discipline is real. Halliburton recently discussed our capital spending plans for 2020 on our recent second quarter earnings call. By committing to that substantial CapEx reduction in 2020, I intended to send a clear message to three distinct groups in the audience. First, I wanted to show investors that this management team is willing to take the necessary steps to demonstrate consistent free cash flow generation. Second, I wanted to tell our employees that capital is going to be intensely competitive internally, and only the best returning projects will get funded. And third, going back to my earlier point, signaling to customers, letting them know that capital equipment is going to get tight. Wall Street expectations aren't just a 1 or 2 quarter event. I believe investors are calling on our industry to generate sustainable free cash flow and strong returns over a long period of time and through multiple business environments. With that said, size and scale becomes very important, and therefore, the industry must seek to consolidate at some level. To date, this consolidation theme has been through some fits and starts, but I believe we'll see continued pressure and ultimately necessity for some of these companies to consolidate in order to survive. And with that comes Wall Street's preference for low premium mergers of equals, which we all know are hard to execute given the complex social frictions that would exist. But as an industry, it's going to take time to adjust to the new normal. But I have no doubt that we will adapt and thrive in this new environment. There will be consolidation of industry players that will aid returns. There will be technological innovations that will help us generate more cash. And there will be thoughtful capital allocation that will allow or foster long-term sustained growth. A Chinese curse goes something like this: may you live in interesting times. Ladies and gentlemen, we certainly are living in interesting times in oil and gas today. But ultimately, the changes we're experiencing in North America are good for the long-term prospects of our industry. Emerging from the industry's focus on cash flow and returns should be stable growth over a longer period of time and less amplitudes to the cycles, rather than the boom and bust that characterized the past in North America. And this sustained, disciplined growth, while generating the leading returns and healthy free cash flow, is what will ultimately reinvigorate the investor interest in oil and gas. So how's Halliburton positioned in this new world order? Well, this year, Halliburton is celebrating its 100th-year anniversary, which has been a truly historic milestone for our company. And let me give you just a little bit of perspective on how hard it is to achieve that today. Only about 10% of the Fortune 500 company from 1955 still exist in the Fortune 500 today. And at the current pace, 50% of today's Fortune 500 will be replaced in less than 10 years. Being a Fortune 500 company who has not only survived 100 years, but that I believe is well positioned for the next, is critical, particularly where you think about where this business came from. Our founder, Earl P. Halliburton, started our company in Duncan, Oklahoma with 2 mules, a borrowed pump, and some cement mixing boxes. Today, we are now a global enterprise with 14 product service lines that operate in 80 different countries, employ over 60,000 people representing 140 nationalities. Getting to 100 years is more than any one person or any one idea. It's the culmination of continued success with our customers and dedication by our employees to develop innovative technologies and to deliver outstanding service. We got to 100 years by evolving with our markets and our customers, and will continue to do so. Halliburton is well positioned to navigate the near term and thrive in the long run. In this new environment, a strong integrated franchise will matter. Size and scale, as I said earlier, will matter. Technology depth will matter. And superior service quality will matter, and I believe Halliburton has all of these. So in summary, the energy industry is certainly going through interesting times. But as the recent events in Saudi clearly demonstrated, the world still runs on hydrocarbons, and any threat to that supply can cause far-reaching tremors across our globe. But as an industry, creativity, adaptability, and focus on the right things that I talked about, returns and free cash flow, will ensure our success for years to come. Thank you, and hook 'em horns. I know we have more time, and it's always intimidating to talk to a crowd when you know that you sit between them and happy hour at Schultz's. But I'm happy to take Q&A from folks. Yes? Yeah, so politics. I'd be careful about that, particularly coming from Halliburton. Do what? Oh, I'm sorry. She asked about what are my thoughts about the new Green Deal. And I think, I sort of stick to my earlier remarks where I think, there could be alternatives out there. But today, I think the most important part is finding the 3 attributes, right? Your ability to tangibly move assets that are affordable and reliable, that lowers the ultimate cost, per energy standard. So tough to say. Halliburton's focused on the things that we believe moves the needle, and that today is that we believe is oil and gas, and that's what we embrace and focus on. Yes?
Curious to know your outlook on natural gas. I think John mentioned he's an oil bull, and I think you mentioned you're bullish on oil, but there's not a lot of natural gas bulls out there.
Yeah, lots of natural gas being produced today. A lot of associated natural gas, right? So even if you're drilling predominant oil wells, you're still producing a lot of natural gas. And so we've become awash in that today, frankly. And I think that there are challenges. If there's anything, even on the gas side versus oil, right, there's markets all around the world that consume or short natural gas. And it's always been hard for us, although we're building the facilities now along the Gulf Coast, to begin to package LNG terminals, right, so that you can begin to move natural gas. But natural gas has always had a problem. It's always been a more regional-based market. And so we see the influx of all the natural gas in the North America market today, and that's where we drive Henry Hub prices that, sit at $2.50 a MMCF. I think as we get better in terms of technology that allows us to transport and ship, I think that will help balance the markets globally. But I think, ultimately today, over time, industry is going to move towards, there's no doubt natural gas is a cleaner burning hydrocarbon fuel. And we see that happening today. Saudi has been very vocal about a lot of their electric production capacity is moving from actual oil to natural gas even in their own country. So I think there's a real shift, and I think I mentioned in my remarks around China as well. So, yeah, today the strip looks pretty weak. I don't see a whole lot of catalysts, at least in Henry Hub and North America, to change that. But what the industry is doing is adjusting, right? They're lowering their cost basis to make it economic, even at those levels. I see a lot of people doing that in the Northeast U.S. Yes?
What does Halliburton think about prospects for China being able to develop its own shale reserves as opposed to being such a strong importer of LNG and crude oil?
Yeah, it's interesting. I think that there were high hopes early on about the quality of their rock. It's interesting. We've taken a pretty cautious approach to what we do in China, just from an IP perspective, and things sort of get reverse engineered and taken in terms of intellectual property. But the reality is, I think the service companies in China are finding it to be much more difficult, and I think that they really struggle with infrastructure. So one of the things that allows us, not only because of the way that we own hydrocarbons privately in the U.S., but we have a 100-year head start on infrastructure that helps us, whether it's trains, roads, pipelines, and in lots of places, particularly where those reserves sit in China, it's really hard to get, once you get it out of the ground, what do you do with it? And so I think that they're finding that it's a little bit more challenging than just signing up for an LNG shipment. So we'll see. It'll be interesting to see how that unfolds over the next several years. We've seen countries that have been able to overcome the infrastructure challenges. It's been an amazing case study in Argentina, which was a net energy importer 4 years ago, set some limits to give operators and service companies some comfort that we would be able to make money for a period of time in Argentina, and so therefore investment in rail and roads and other infrastructure has totally flip-flopped their energy dependence to actually be abundance. And so it's capable. It's a pretty interesting case study if you look at the way that Argentina has grown their hydrocarbon production in just 4 years. Yes?
Houston campus and your employees do with the last storm?
It's a great question. I was there yesterday, actually. We went home a little early. I think people's commute was a little bit longer home. Thoughts and prayers are with those that may have been affected personally by the flooding. It was quite the storm. I don't know that anyone expected sort of the trailing tail of the storm to be as impactful as it was. And in fact, I was looking out my office at one point, and I'm talking to our chief human resources officer, and we're saying, okay, what are we doing today with all these employees? We have about 3,500 employees that sit on our North Belt campus. I said, okay, what are we going to do? And at that period of time, it was raining so hard. It wasn't coming down in sheets. It was coming down in like a wall of water. And, the point was it's just everyone just needs to stay put for a minute because you're not going to go anywhere. And, in fact, someone tried to leave, and I could see it right out my window down towards the main gate. I overlooked the main gate, and someone flooded their car on our campus in the road that became a river in a matter of an hour. So yeah, it was a longer commute. I think, it's becoming the new norm with all the concrete that we have in the Houston area to find problems with drainage. But yeah, it was a tough 48 hours, and particularly for the people east of us. Houston sort of got touched lightly yesterday, I would compare to what the Beaumont and Winnie community is going through right now. Yes, ma'am.
Lance, in your shift from the financial services industry to corporate and in leading a large team as the CFO, what have you found to be some of the biggest leadership challenges you faced in making that transition?
Yeah, I think, when I said a couple things earlier, and the second point, I think, was one of the most important ones. And I received this bit of advice from my managing director at one time in investment banking. I felt really strongly about this idea, and I really wanted to push it with the client. And finally, my MD was tired of being nice and polite and just said, Lance, do not delude yourself. And so, look, I think it's really important. My promotion, I came out of, so everybody that now reports to me was a colleague. And so I'm fortunate enough to have worked with them in my prior job. So at Halliburton, I didn't get into too much detail in my remarks, but when I started Halliburton in the sleepy corporate job, 3 days into my role, I sat down with the CEO at the time, who was Dave Lazar, and he wanted to talk about the infancy of the Baker Hughes transaction. So I had a crash course, even though I was new to Halliburton. I was forced to take a crash course in the way that we organized our businesses, because ultimately, when we announced that transaction 2.5 months later, my role pivoted, and I was then working on the divestitures, 5, for those that are counting, that were each above $1 billion across 2 companies to satisfy the regulatory approval for the combination. And so I mentioned earlier, I was 38 years old, and I was talking to the director of the Department of Justice for just those reasons, to prove to them that we could not just carve out and sell business lines, but that we could actually sell whole companies. And so I had to go into an organization like a lot of the large cap oil field service, the integrated service companies have done over time, to create their own synergies and lower cost structure by sharing services. Now I had to completely unwind that and actually allocate back to these businesses as I was selling them. So it gave me a real opportunity to understand our systems and work across all the functions in finance. So I had to work with, not only was I the M&A guy, but I had to work with our chief accounting officer. I had to work with internal assurance. I had to work with IR to a certain extent. So I got to know my team really, really well and worked really well with them. I know where I have my strengths and where I don't. And thankfully, the people that report to me fill those gaps that I will build over time. But so I think I've been very blessed with the team that I inherited. I think outside of that, what surprises me and what has been more of a burden, not burden, I shouldn't say burden, has been something that I underestimated when I took the role, was the level of work that I do with the board. So I knew that I'd be working very closely with our audit committee chair, which I've been really thankful for, Alan, and what he does for us. But my role in board meetings it's sort of like Lance is doing everything. And so you have to know a lot. You have to be on your toes. They like to keep those meetings efficient and effective. And that was something that I didn't know that I expected, but has been a good transition so far.
On those 5 divestitures, did you bring in sell-side bankers?
I did. It's kind of funny. So once you're sort of on the other side of the curtain, seeing how much the investment banker actually does in those processes becomes kind of a joke. I'm like, wow, I thought I was really important when I was on one side of the aisle. Now I'm on the other side, and it's a little different. Yes, we did. So we had one bank that tried to oversee all 5. And then I had individual investment banks that were leading each transaction, just to make sure everyone stayed on sides and we didn't get cross-pollinated in a relatively small market. Ultimately, the deal failed, right? But a lot of it was due to the collapse in crude when OPEC, namely Saudi Aramco, put the pedal to the metal in. I think we announced the Baker Hughes transaction in and around November 12th of 2014. And that pedal to the metal that I just described was Thanksgiving weekend that same year, so it was like 2 weeks later. But ultimately, the cycle chewed it up. The Obama administration and the regulatory side of it was not helpful, but there was not a lot of incentive at that point from an economic perspective. I spent a lot of time working with the board because the breakup fee was $3.5 billion. So I had to present quite a bit to the board at the time in the M&A role to convince them that the value that we would be destroying by selling these 5 businesses at way below what their true market value was worth because of where we were in the cycle was far greater than the $3.5 billion that the check that we'd have to write. And so that's indeed what happened. We terminated the transaction, wrote the check, and at the time, Dave, who was our CEO, I think said, "Man, Lance, you did such a great job explaining that to our board. I want you to go explain that to a bunch of angry investors." And so, so that's when they moved me to investor relations, and I spent 2.5 years there. And investor relations at Halliburton is a pretty unique. It is a whopping team of 2, believe it or not, even for the size of our organization and all the things that historically we've gone through, whether it's been Cheney days or Macondo, et cetera, a team of 2. But what it really forces you to do is really learn the entire organization, right? You could walk into any meeting at any time, and, you know, even some of the small hedge fund guys that, you know, technical engineer will start asking you about how your pump works and how it's different than the other guys and all that. So you're forced to know a lot of different things. And so, again, not only did my M&A experience in learning the internal guts of Halliburton help prepare me for my new role, but so did my experience in investor relations teach me to know the whole organization and not just the directional drilling business that I was selling or the bits business that I was selling or the completion tools business that I was selling. I had to know all of Halliburton, and I think that was a really good opportunity to round me out before the new role now. What else?
You see a transition to CEO at some point?
I don't know. Never say never. My predecessor in the CFO role is now the CEO at Weatherford, which is a competitor. So that could happen down the road. I'm still relatively young in my career. I really enjoy. I didn't say this, but I should include this because I think it's really important. Is I wasn't willing to settle when I came out of financial services. So I had an opportunity, again, had been doing it for close to 10 years. I had an opportunity to really see a wide variety of management teams. And I always knew that if I left investment banking, there were 2 companies that I thought had extremely polished, well-functioning management teams. The first was Halliburton, and the second was Valero, just from my point of view. Just personality fit. And so when I had that opportunity to jump ship and go to Halliburton, it was an easy decision. Even if it meant somewhat of a financial setback personally, I knew it would be a great start to a new chapter in my career. Yes?
Just a question around consolidation. Are you seeing that there's kind of agreement of perceptions around the bid-ask so that that consolidation can actually happen?
I think it's going to be forced, John. I think this is really, really interesting to see this playing out. Now, we get asked a lot by investors, is Halliburton going to be a consolidator in pressure pumping, for example? And the answer is no. We run sort of a 747 Southwest Airlines model in terms of we're snobs about the equipment that we manufacture ourselves, and so therefore we want it to be sort of all Halliburton, not mixed and mingled. So we won't be the consolidator, but I think what's interesting, and even beyond just what we see going on in oilfield services, but I think the operators, if you're a small or mid-cap operator today, given what we know that the market is looking for, right, where they're not going to reward growth, for those people that are stuck in the middle, where are you going? In particular, some of our customers, right, the operators, that are being forced into free cash flow yield vehicles, which in my view, philosophically, there are so many, if it's free cash flow yield that you're looking for, there are so many different business models out there that do a much better job of that than an E&P company where their assets decline, particularly in North America, severely every day. And if you're not reinvesting into the ground and the drill bit, then you're shrinking. And so you have all these management teams and boards struggling with how are we going to balance this? How are we going to make our investors happy and have something left at the end? And I think ultimately, I think 2020 will be an interesting year. So far in this cycle, the way that operators have been able to generate better returns and somewhat healthier free cash flow has been on the backs of squeezing the service companies and finding structurally lower sand, which is a big input to the cost of a well. So today, or in the beginning of the year, sand was 40 or 50 bucks a ton in West Texas. Today it's at 8. But it can't go to -8. They're not going to give it away. So the question becomes in 2020, where do the E&Ps go find that value in, because so far they've just been focused on lowering the cost of the well. And I'm not convinced that they've actually been focused on making a better well. That's going to be the long-term driver for value for these companies. And so if boards don't get that, and they don't figure out a way to consolidate to find something, right, that helps protect them from a size and scale perspective, then they could fight this all day long and end up with nothing at the end as well. I mean, it's just, this was a catalyst for the Keene C&J deal, right, which is I gotta find a way to get bigger. I need to get more liquidity in my stock so my private equity investor can get out over time. I mean, we have to remember that we have a lot of private equity that's still stuck in investment, both on the E&P side and on the services side in this industry, but they can't get out because there's no volume. And every day they just see the ticker trade down and down and down and down. And so I think 2020 is going to be an interesting year for our industry, because in the midst of all that, right, two things are going to happen. Either the E&Ps are going to say, you know what, we can't live under these rules. We're just going to grow. We're just going to spend more, right? And that'll be good for the service sector, Halliburton in particular in North America. But to the extent that they don't and they slow down, and we're starting to see some gaining momentum around hitting the brakes because they're trying to show a free cash flow number, so I'm going to underspend CapEx for this year, so the fourth quarter could look real ugly, right? But there's going to be a production impact given the fact that if you go back and look at the vintage of wells that have been produced, going back to 16, 17, 18, 19, the decline curves are just getting steeper and steeper, which means the treadmill is just going faster and faster and faster. And so if these folks don't invest in the drill bit, then you're going to see a production response that will be positive to the macro and to the international markets where half of Halliburton sits today too. So, but you can't say that for a lot of the North America smaller mid-cap guys, right? I mean, they're really attuned to what's going on in North America, and I think it begs for a really tough market, and I think it'll be interesting to see. My personal view is that it's less about, I used to think it's just the CEOs, merger of equals, why would I do that? I want to be the guy, no, you want to be the guy. And I'm more and more convinced today that it could be the boards. Not everyone wants to give up their board seat. But at the end of the day, if you're getting compensated with a lot of stock that may be zero at the end, you have to kind of think about that. Anyways, yeah.
Are you seeing any surprise resurgencies or surprise precursors to new shale basins, or surprise precursors to resurgence in old established shale basins or types?
Yeah, I mean, the things that we're watching today is production per linear foot, right? So there are no new Permian basins, at least in North America, that we found today. But what we're watching in North America specifically, I'll get to the rest of the world in a second, but in North America specifically is what is the rate at which these companies are actually building a better well? Leave cost aside for a second. And what you're seeing is a lot of these basins, as they mature, that production per linear foot begins to flatten out, right? So you have levels, years of experimentation where they're figuring out how to put the sand, where to place the sand, how long to make the lateral, right? And then all of a sudden, we hit this plateau, and two ways to solve it. I either do more, right? As I get into harder rock, I have to do more because it's harder to get the same amount of production, right? Or I rely more on technology, right? Which is where Halliburton has placed a tremendous bet. Outside of that, in terms of exploration, our industry has actually done, over the last 5 years, I want to say, a terrible job of investing in exploration. So what you see happening in the international markets today is all brownfield, right? Nothing greenfield, with the exception of what Exxon has found, partnered with Hess down in Guyana. But outside of that, it's all basins that we know, and it's all been tiebacks, whether it's the North Sea, Middle East. And so to the extent that we ever have a call on the next leg up as demand continues to rise, I think it's it's longer cyclicality, right? But it will be interesting in future years because of the lack of investment that we've invested over the last 7 in exploration. Christine?
Lance, thank you so much.
Okay.